IASB finalizes two major IFRS accounting standards to improve financial reporting. February 2025, the International Accounting Standards Board, IASB, has completed the technical work on two significant new international financial reporting standards, IFRS, that aim to enhance financial transparency and simplify disclosures for subsidiaries. According to IFRS, these new standards will impact the way companies present financial statements and will help investors better understand financial performance. Both new standards, one focusing on financial performance reporting and the other on reducing disclosure burdens for subsidiaries, are expected to be officially published in mid-2025 and will take effect for annual reporting periods beginning on or after January 1st, 2027. Early adoption will be permitted, allowing companies to implement the changes ahead of the mandatory deadline. Let's break down what these new standards mean, why they're being introduced, and how they will affect businesses, accountants, and investors. 1. The Financial Performance Reporting Standard. One of the biggest changes is the introduction of a new IFRS standard aimed at improving the consistency and transparency of financial performance reporting. This standard will replace the existing IAS 1, Presentation of Financial Statements, which has long been criticized for allowing too much flexibility in how companies report financial performance. Under the current system, companies have significant discretion in deciding what performance measures to highlight and how to present them, often making it difficult for investors and analysts to compare financial results across different businesses and industries. The new standard seeks to eliminate inconsistencies by requiring a structured and uniform approach to financial reporting. Key features of the new Financial Performance Standard. Standardized categories for income and expenses. Companies will be required to classify income and expenses into specific categories. This ensures consistency and prevents businesses from presenting financial results in ways that may be misleading. New requirement for subtotals. The standard will introduce new mandatory subtotals in the income statement, including clearer distinctions between operating profit, investing activities, and financing activities. Enhanced disclosure on management-defined performance measures. Many companies currently present adjusted earnings or non-GAAP measures that are not always comparable between firms. Under the new standard, companies will have to clearly define and reconcile these figures to IFRS financial statements, preventing selective presentation of financial data. Increased transparency for investors. By requiring clearer financial statement structures, investors and stakeholders will have better visibility into the true performance of companies, reducing the risk of misleading financial disclosures. Why is this important? The move towards a more standardized approach aligns with global demands for greater transparency and comparability in financial statements. Analysts and investors have often expressed concerns that the current reporting flexibility allows companies to emphasize positive figures while downplaying negative aspects of their performance. The new standard will reduce such concerns by ensuring consistent and unbiased presentation of financial results across industries. 2. The reduced disclosure standard for subsidiaries. Another key development is the introduction of a new standard designed to reduce disclosure burdens on subsidiaries that do not have public accountability but still need to comply with IFRS. This new standard will be particularly beneficial for large corporate groups with multiple subsidiaries. Currently, subsidiaries that apply full IFRS standards must provide detailed financial disclosures, even when they are not listed on stock exchanges or accountable to public investors. This often leads to unnecessary complexity and administrative burdens for companies with large corporate structures. Key features of the reduced disclosure standard. Targeted disclosure requirements. Subsidiaries will be allowed to prepare financial statements under full IFRS but with reduced disclosure requirements, making financial reporting simpler and less time-consuming. Who benefits? The change will mainly benefit private subsidiaries of publicly traded companies that currently follow full IFRS but do not need to disclose as much financial information as their publicly listed parent companies. Alignment with the parent company's accounting. While disclosures will be simplified, subsidiaries will still use the same accounting principles as their parent companies, ensuring that financial reports remain consistent within a corporate group. Less costly compliance. By eliminating unnecessary reporting requirements, companies will save time and money while still complying with IFRS principles. The new standard responds to long-standing concerns from private subsidiaries and multinational corporations about the high cost and complexity of preparing full IFRS-compliant financial statements when they are not publicly traded. By reducing the disclosure burden, the IASB aims to improve efficiency in financial reporting while maintaining transparency and accountability.
Implementation timeline and next steps. Official publication.
The IASB expects to issue both new standards in mid-2025. Effective date. The standards will become mandatory for financial periods starting on or after January 1st, 2027. Early adoption. Companies will be allowed to adopt the standards earlier if they choose to do so. Conclusion. A major step towards better financial reporting. According to IFRS, these two new standards represent a major milestone in financial reporting. They are designed to increase transparency, improve comparability, and reduce the reporting burden on subsidiaries. For investors, the Financial Performance Standard means greater clarity and comparability of corporate earnings, while the reduced disclosure standard will make financial reporting more efficient for subsidiaries without sacrificing transparency. With the changes set to take effect in 2027, companies will have time to adapt their reporting systems, train accounting teams, and ensure a smooth transition to the new IFRS framework. As businesses prepare for these changes, the financial world is watching closely to see how these standards will reshape corporate reporting in the years ahead.